Chris co-founded Caliber in 2009 in Scottsdale, Arizona. He's the founder and CEO of Caliber Wealth Development Company. Caliber is a full-service real estate investment firm with a private equity portfolio valued at $265 million in assets under management across 5 states and 700 employees. He's a member of GPL, Greater Phoenix Leadership, and we're pleased to have you with us.
Thank you very much. Appreciate it.
So thank you. Quick thank you to Big Yam for hosting us today, and for the sponsors here and the other entrepreneurs who have very inspirational stories and something that we can follow on. I show you that video just simply because I'm actually not going to be telling you too much about Caliber and our story. I thought with the audience today and the fact that there might be other business owners in the room and other business owners who see this, who are looking at going down the Reg A path that we're going down, that it might be the most valuable thing I can do is share with you the decision-making process that I went through and that our co-founder went through and that our executive leadership team went through to decide how are we going to raise capital, why are we raising capital, what's the value, what are the ups and downs and the good and bad, why Reg A plus, and where are we at today. So I could sort of take you through that decision-making process. I think that's the most valuable to you. I'll probably talk to you a lot about the mistakes that we've made along the way, because I think that's how you learn. And in doing so, I want to start with the disclaimer that Caliber is a great company. We're doing really well. Everything's going good. We have over 465 active accredited investors who've invested with us over $200 million in equity capital over about a 10-year period, mostly into different various forms of private equity real estate funds. So what's a private equity real estate fund? It's a fund that we build with typically a specific purpose to go out and buy different types of real estate. We buy the real estate, we fix it up, we make it better, we make it more profitable, we manage it for a profit, and we sell it for a profit. That's conceptually what we do. And behind all that, Caliber actually owns and operates all the businesses that are required to do that. So construction and development and property management and maintenance, what you would generally refer to as a vertically integrated business model. That's who we are, but the reality is we have built our business with less than 0.1% of the U.S. accredited households in the country, and that doesn't include accredited investors across the world. And so with less than 0.1% of the market, we've achieved I think a great feat. We're on track that if we were able to capture 1% of the marketplace in the U.S., we would go from $300 million in assets under management to $3 billion, which obviously gives us a lot of growth for the future. And so when we looked at the decision of how we were going to grow our business, we realized we needed an infrastructure to capitalize our operating company beyond just the fact that we raise money into these different funds and buy the real estate. We needed to be able to hire great people, grow our business systems, grow our ability to continue to survive through ups and downs in the market and thrive, and take advantage of changes in the market. So that's us, that's who we are. Just a little bit about me. Our co-founder, Jennifer, and president is here as well, so please take some time to say hello to her as well. I'm a recovering accountant. So I started my career at PricewaterhouseCoopers auditing public companies and thought I would never do that again. That was dumb. You know what? It was actually, the further I get away from my accounting career, the more I appreciate it. I think it's like nostalgic now. I kind of miss it. And when we first started down this path of going public, I said, well, I've audited public companies. I know what the mechanics and the process of this is. I know what I'm getting myself into. I did not know what I was getting myself into. The other piece I think that you should know is that myself and Jennifer, we're both entrepreneurs, and we are, by the grace of God and the grace of this business community, successful so far in Arizona, thankfully. You guys have enveloped our company in your community. You've helped us grow. All of you, in some way, shape, or form, have contributed to our success and continue to do so. And because of that, this is our opportunity to give back. And one of my gives to anyone here who's thinking about this is if you're an entrepreneur, you've got a company that's doing 20 million in revenue or more, or is on that path to get there, you want to figure out how you're going to fund your next step, I'll spend time with you. I'll walk you through your story, your process, confidentially, and tell you, here's who I would work with, here's how I would do it based on the multiple years of experience we have. Hopefully that will help you along your way, your path. Also with us today, we've got a handful of our executive leadership team. Roy Bade here, Travis Okamoto, and the CFO, Jade, is back dealing with the auditors. But as anyone knows who's built a great business, it's about building a great team, and that's why we brought some of our team members here if you want to talk to them. So, 5 things to share with you about this process. First things first, if you own a business and you're looking at this as an option, the number one thing you should figure out is, what are the benefits? Was the juice worth the squeeze? Are you willing to do, what are you trying to get to? You know, if you're just trying to get capital, is there an easier way for you to get capital? If you're trying to exit and sell your business, is there an easier way for you to do that? And I would submit to you, for the middle market companies, which are the engine of the world, as everyone knows but doesn't seem to want to support as much, there's not a lot of great options out there. You know, private equity firms kind of beat you up, and they want to take control, they want to take your money, they want to take your valuation down as far as possible so they can create a spread, so they can sell you 5 years later for the biggest possible number. Venture capital is good sometimes if you're lucky, and sometimes not. Raising money from individual accredited investors to fund an operating business is hard, because guess what? Whatever you tell them the moment they sign the check is wrong an hour later, right? Because business is an organism, it changes. And whatever you think you know today, you don't know tomorrow. So you have to be, willing to go through that process. And if I wrote a $500,000 check into an operating company, I've got a lot of risk. If I wrote a $5,000 check online in a campaign, I took a risk, but if it doesn't go well, I'm not nearly as concerned, right? So the check size, smaller check size, allows people to take greater risk, in my mind. So what do we do at Caliber? How do we make this decision? Number one, first and foremost, we were looking to access growth capital at the cheapest possible price with the least amount of dilution to our ownership and the best ability for us to remain in control of the vision and the direction of the company. And so whether that came from private equity or from family offices or from any direction that we looked at for capital, whatever achieved that goal was probably going to be one of our best paths. And for us, Reg A plus and the public offering and the format that we're doing it was the answer. That's not always the answer for everybody. Every business is different. But for us, this allowed us to sell the least amount of the company to get the capital we needed to grow and retain the most amount of control. Simple, right? Number two, for Jennifer and I, and for the founders at Caliber, we wanted to reward our people and make them owners in the company along with us in a real format. So you typically open an LLC, you get some profit sharing interest and that kind of stuff. So we wanted to make sure that we rewarded our people, and the only way we can do that is through ownership in the stock, real stock, and stock that actually has a value that can trade eventually, that they can get the value that we're building in the company, they get to participate in. That was important to us. And come to find out, human beings are kind of really important for business. The better the human being you attract to your company, typically the faster the company moves in a positive direction. And if you can come into a company and own real stock in the business that's going to the NASDAQ in 3 years or whatever their plan is, that's really attractive for some pretty talented people. We've hired some people who could frankly work for a lot more than what we pay them because they know where we're going and they get to participate in that. So that was very important to us. In our business model, we go out and buy big pieces of real estate. We build value in them. That value has an interest to us. We get a portion of those profits. It's called our carried interest. That carried interest is worth many, many millions of dollars to us, but it's not worth it. It's worth nothing to us until we sell the property. So one of the greatest things about going public is you get to access the value you're going to create tomorrow, today. How do they do valuations when you do a public offering? Typically current results plus 3 years forward-looking, discounted, right? So you get to basically sell your company for what you're going to be worth in 3 years today, more or less, right? So if you're on a fast growth track like we are, that's important because that gives us more money now and then we take the money and we actually create the results. So conceptually, that's why we decided to go this path. And then last, for us, being a public operating company that sponsors private equity real estate, we borrow a lot of money from a lot of institutions. Every bank, insurance companies, agency debt, CMBS, mortgage-backed securities, we've done it all. And if you're a private company, they look to myself and Jennifer as the sponsors of that debt, and they want us to sign away our left arm and our cat and dog and whatever. If you're a public company, you check different boxes, you get better pricing on the debt, makes the assets more profitable. So for Caliber, for our specific situation, being public is actually a big benefit. Not every company's that way, and I encourage you as you look at your own business to go through the exact same litmus test to decide if this is the right move for you. Why not? Why would you not go public? Number one thing people cite, more cost, right? You got to have an audit. You got to have lawyers that you have to do filings. You have to be able to maintain the infrastructure of a public company. You have to have IRPR, which is investor relations, public relations. You got to have a lot more infrastructure in place. Well, for us, for our specific situation, we already report to investors. We already audit our private funds. We already go through a lot of that kind of stuff because we're regulated security and we have a lot of product level risk. And so because of that, our incremental cost of being public was not that much. And I would encourage you to look at your own business, and if you're governmental, if you have large financings, you're probably doing quite a bit of the work already. So you incrementally layer on a little bit more cost, and your access to capital markets might improve substantially. That may not be true if you're manufacturing lawnmowers and you've never had a loan, right? Transparency and accountability. Some people don't want to deal with that. They don't want to have a shareholder be able to call them up and say, why'd you make that decision? That's built into the core and the fundamental fabric of our company. That's how we raised money in 2009 with no track record and no starting point, because we just told investors the truth, and we showed them exactly what we were doing, and then we did it. And then they saw that we did it, and then we did it again. We did it again, and we did it again. And so for us, transparency was not something to run from, it was something to run towards. Some people go in the opposite direction. It just depends on your business. I actually don't think one's good or bad. And then, we can no longer do whatever we want with our company. I would submit to you that you can never do whatever you want with your company. The market decides what you're going to do with your company. The market and your customers. And so if you're under the illusion that you have the ability to just make any decision you want and take your company in any direction you want to go, I think that you might be a little lost in the world of business. In my experience, it's the market that decides where we're going. And so this is just a much more efficient way to get information from the market much faster. And then, another reason to not go public, you could get the capital that you want at the price that you're willing to accept somewhere else. If you can do that and it fits your business model and your life and where you want to go with your business, there's a lot easier ways to get capital. So I would submit to you that you consider that. Our cautionary tale is that we started down this path almost 3 years ago. We started down this path at a time when the company was smaller, when the idea of raising $5-10 million, doing a listing on the OTC sounded like a good idea. At that time, the microcap industry, actually the microcap stock industry had not fully imploded. There were still broker-dealers out there selling microcaps, and there was a whole infrastructure for it. You could go on these sort of road shows, and these, you'd have seminars, and you'd pitch your stock, and there was something that existed. And I guess fortunately enough for us, we had two things happen. We grew fast, so we got to the point where doing an OTC listing and raising $5 million wasn't really going to move the needle for us. That was a positive. And on a negative side, the micro cap industry, the broker dealers, basically the people who buy and sell these stocks, these small stocks, disappeared, more or less. And so with that happening, the marketplace went away. If the marketplace goes away, then how are you going to raise the money? You have to go find a new marketplace. And so as we did that, we realized that, well, Caliber grew our way out of this problem because now we can do direct to NASDAQ listing. We're ready to go based on the market cap we expect to achieve. So for us, it became not a problem, but it depends on this. What I would tell you is it depends on the size of your company and the ultimate market cap you're going to achieve. If you can do a direct to NASDAQ, direct to New York Stock Exchange type listing, then I would suggest you do this, potentially. If you can't, then I would suggest you look at not listing the stock for a substantial period of time until you can, and so being a public reporting but non-listed company, and I can talk to you about that in Q&A if you want. If you can't, if you're looking at trying to build a market in the OTC, my advice to you, based on my experience, would be it's too early. That's what I think. I'm just one person out of 350 million. So there's other people that could tell you something different. Choosing the right providers. The next step was, first, why would we do it? Second, why wouldn't we do it, right? Third was, what was our timing? Did we have the right timing? Do we have the right plan for the timing? Number 4, this is where we made our biggest financial mistakes, was that we picked our initial round of service providers, so consultants and advisors and investment bankers and accountants and lawyers, all based on how the company was sized at the time, not based on where we were going, right? And these guys, I'll keep it PC, but these guys knew what they were doing to raise $5 million for a non-existent company to go drill for oil, right? They knew how to open a shell and raise some money and hopefully have some success. But they didn't know how to take a company like us that has complexity at the accounting and financial reporting level of a multi-billion-dollar accelerated filer that has multiple complex accounting issues, includes consolidation accounting and fund accounting and whether or not we're going to be considered an investment company or not and all this stuff. They didn't really know what they were doing, frankly. And we didn't know that they didn't know what they were doing. So we spent a lot of money and time and effort learning ourselves as entrepreneurs that the people we had originally hired were not the right people to work with. And then we had to go through the process of finding, well, who are the right people to work with? And so I would tell you that the people that we've invited to be here today or we've helped to be here today are attorneys from Manat, B. Riley, John Merriman, others are not the first people we hired. We brought the best of the best of what we think are the best that we've chosen. And that's hopefully to help the Arizona business community bring the right people to the table based on our experience. As an example, our original PCAOB audit firm got 2 years in the audits. They had audited 3 years of financials. We were supposed to sign off. We were supposed to start the registration statement process. And in November of the year that they came to us, they said, you guys have this memo on fund accounting or something like that, and we don't have a partner in our firm who's qualified to answer whether or not you guys are right. So we can't finish this audit. We paid them 90% of their fees, and they were supposedly 95% complete with the audit. So what's your choice? Do you sue the auditor? That accomplishes nothing, right? We moved on. We found a better firm, and we redid all the work. So, those types of things will happen if you choose the wrong people, and I'm doing the best I can to emphasize the importance of choosing the right people, and I think all the entrepreneurs here can tell you the same. Number 5, last, but where most of the time's been spent today has been about marketing and building your shareholder base. This is where this stuff gets really fun. This is exciting for us. We built our company with 450 investors. We have 30,000 in our database who've been following us for a long time. Most of them can't invest in our stuff because they're not accredited, which means that they're not qualified to invest in a fund that buys single-family homes with 50% debt and keeps them as rentals, but they are qualified to invest in foreign exchange products and complex bond funds. Different topic for a different day. So at the end of the day, this gives us an opportunity for the first time ever as a company to have a product we can sell to a much larger market. We can sell ownership in our company. We have, of those 30-some thousand people that don't have any ability to buy anything with us right now, many of them have been following us for years. And if they can buy $500 worth of our stock or $1,000 worth of our stock, guess what? They might have a brother or a sister who's a doctor. They might have a cousin who owns a, successful mid-market business. And so it gives us a way to connect with more people in a meaningful way. And I would suggest that if you own a business that's looking at doing something like this is one of the biggest values you can get out of the Reg A process, besides the capital and besides all the other benefits I listed, was a way to connect with a larger audience that really will care about the success or failure of your business. Pop quiz. All of you guys have probably family and kids and people you care about, right? If you have to take all of your money, every dollar you have, everything you've ever made, you'll never make another dollar, and you have to invest it in one company that's available on the current stock exchanges because you think that company is going to be the only one that's going to be successful, which one do you invest in? Anyone? Apple, Amazon? Berkshire Hathaway. We have a consensus. Berkshire Hathaway, when it was first offered to the public, was funded by institutional capital, right? Because the institutional capital in the country, the people, the big hedge funds and the big pension funds and the billion-dollar families and the Gates families, and those are the ones that know everything, right? So they invested in that company because that's the best company, right? No. Berkshire Hathaway raised their money from retail investors, which is what they refer to us as, individuals who bought their products or who were associated with the company in some way, shape, or form, and spent years building their company with their base of customers. Because Berkshire Hathaway, just like Caliber, can't explain their business in 10 seconds or less on a single sheet of paper. It's more complex than that. There's more to it. And that's what institutional capital is looking for today. If you go to New York and do a road show, which we've done, and try to pitch investment bankers on our company or probably some of these other companies, they give you, it's 10 minutes. They want to know so you're a regional manager of apartment complexes in the Southwest with a value-add focus and da-da-da-da. But you also do, no, you can't do hotels because hotels, that doesn't fit the bucket, and da-da-da. And we can't get you any money if you do hotels because that's not apartments. And how could you do hotels and apartments? Who could possibly figure that out? These are real conversations we've had, right? So hopefully, I brought you some level of my candor and experience. This is, for us, the opportunity to speak to you today was not a sales pitch. It was an opportunity to share with our business community that's helped us grow our company, our experience, and hopefully anyone that's in the audience today or in the future when we do these summits will, take a look at Reg A as a great opportunity to grow your business and go down a better decision-making process than we did. Because the bigger community we build of great, successful Reg A companies, the more likely it is we have a better marketplace for ourselves. It's capitalism at its best. Good judgment comes from experience, and a lot of that comes from bad judgment. So I leave you with that earth-shattering thought, and look forward to doing the Q&A.
You can hold on.